There's a version of you that bought Bitcoin at $3,000 and never sold. That version doesn't exist, but the version who bought it at 64,000 and watched it crash, that one's real, and there's a lot of them. Here's what actually happened. Crypto didn't make most people rich. It made a small number of people extremely rich, and it made a much larger number of people convinced they understood something they didn't. That gap is the whole story. So let's break down exactly where the thinking goes wrong, because it's not really about crypto. It's about how people confuse a market with a system, and a system with a guarantee. Start with the basic pitch. Crypto bros will tell you it's decentralized, it's the future of money, and early adopters always win. Two of those things are technically true. The third is where everything falls apart. Decentralization is real. Bitcoin doesn't have a CEO. Ethereum isn't run out of a corporate office. That part checks out. The future of money claim is debatable, but it's at least a real conversation people are having, from central banks to payment companies. But early adopters always win? That's not how markets work. That's how lotteries get sold. Here's the part that doesn't add up. If you actually look at the numbers, in 2021, over 40% of Bitcoin holders were sitting on losses at some point during the year, according to on-chain analysis from that period. 40%, not the outsiders, not the people who missed the boat, the people who were already in it. So, why does the narrative never mention that? Because survivorship bias is doing all the heavy lifting. You hear about the guy who put $5,000 into Dogecoin and bought a house. You don't hear about the 9 other guys who put $5,000 into 9 other coins that went to zero. Nobody makes a documentary about the guy who's still working retail. This is where you need to understand a concept called selection bias in returns reporting. When an asset class has thousands of different coins, and only a handful moon, the ones that moon get amplified across every platform. The ones that don't just quietly disappear from the conversation. So your perception of the average outcome gets skewed by the loudest outliers, not the actual average. Think about it this way. If you flipped a coin 1,000 times and only told people about the times it landed heads 20 in a row, they'd think the coin was rigged in their favor. It's not rigged. You're just cherry-picking the streak. Crypto influencers are, whether they mean to or not, cherry-picking the streak. Now here's where it gets stranger. A lot of crypto bros genuinely believe they're not gambling. They think they're investing, and the difference matters more than people realize. Investing means putting money into something with the underlying cash flow, a business, an asset that produces value independent of what the next buyer thinks it's worth. A stock pays dividends because a company sells products. Real estate generates rent because people need shelter. Bonds pay interest because you loaned money and expect it back with a premium. Most crypto has none of that. Its price is almost entirely a function of what someone else will pay for it next. That's not investing, that's speculation. And speculation isn't inherently bad, but calling it investing changes how people manage risk around it. If you think you're investing, you hold through a crash because it always comes back. If you know you're speculating, you size your position so a total loss doesn't wreck you. That distinction alone would have saved a lot of people a lot of money in 2022. So what actually happened in 2022? Let's use real numbers. Bitcoin dropped from roughly $69,000 in November 2021 to under $16,000 by November 2022. That's a decline of about 77% from peak to trough. 77%. For comparison, the S&P 500, one of the most boring investments that exists, dropped about 25% in that same window, and it had a 200-year track record of eventually recovering. Crypto had existed for about a decade. Here's the twist that a lot of people miss though. Bitcoin did recover. By 2024, it had climbed back above its old highs. So does that mean the people who held were right all along? Sort of. But only if you can answer one honest question. Could you have actually held through a 77% drawdown without panic selling, without needing that money for rent, without checking your phone every 4 hours in a spiral? Most people can't. That's not a character flaw. That's just human behavior under financial stress. And the people selling you the just hold diamond hands narrative are usually the same people who already made their money on the way up and have nothing left to lose by telling you to hold. This is the mechanism you actually need to understand. It's called asymmetric risk exposure. The person telling you to buy the dip already has gains locked in from an earlier entry point. If it goes to zero from here, they're still up. If you buy now and it goes to zero, you're just down. same advice, completely different risk. So what do rich people actually understand? That the loudest crypto voices don't say out loud. It's not that crypto is fake or a scam. Plenty of legitimate technology and value exists in the space. It's that position sizing matters more than conviction. The wealthiest people in any speculative asset class, whether it's crypto, startups, or collectibles, almost never put more than a small percentage of their total net worth into any single high volatility bet. Financial advisors who work with high net worth clients often cite a range of 1 to 10% of a portfolio for speculative assets, depending on age and risk tolerance, not 50%, not their entire savings account, a slice. That's the boring, unsexy truth nobody wants to put in a thumbnail. Rich people aren't smarter about picking coins, they're smarter about how much they're willing to lose. There's another layer to this that rarely gets mentioned: taxes. A lot of people selling their crypto gains don't set aside money for what they owe. In the United States, selling crypto for a profit is a taxable event, the same as selling a stock. Some people made real money on paper in 2021, spent it, and then owed capital gains taxes the following spring on profits that had already evaporated in the 2022 crash. That's not a hypothetical. That happened to a documented number of traders, enough that accountants started warning clients specifically about it. So even the people who technically won sometimes ended up in a worse financial position than if they'd never touched crypto at all, simply because they didn't plan for the tax bill on gains they no longer had. That's not a crypto problem specifically. That's a financial literacy gap that crypto happens to expose faster and harder than most other assets because the swings are so much bigger and so much quicker. So what should you actually do if you want exposure to crypto without betting your financial future on it? First, separate your speculation money from your actual savings. If a total loss of your crypto holdings would change your ability to pay rent next month, your position is too big, period. Second, understand what you're holding. Bitcoin and Ethereum have over a decade of track record and real infrastructure behind them. A coin that launched last month because an influencer tweeted about it does not. Third, stop treating volatility as a personality trait. I have diamond hands is not a financial strategy. It's a coping mechanism dressed up as conviction. And fourth, if you wouldn't explain the investment thesis to someone in one sentence without mentioning the price going up, you don't actually have a thesis. You have a hope. Here's the thing, nobody selling you a course wants you to sit with. The crypto market isn't lying to you. The math is public. The charts are public. Anyone can see the 77% drawdown, the 40% of holders underwater, the thousands of coins that went to zero. The lie isn't in the data. It's in what gets amplified and what gets left out. So the next time someone tells you they got rich off a coin you've never heard of, ask them one question, not which coin. Ask them how much of their total savings they put in. That answer tells you everything the highlight reel left out. There's a version of you that bought Bitcoin at $3,000 and never sold. That version doesn't exist. But there's a version of you that understands risk well enough to make smarter decisions than 90% of the people yelling about crypto online. That version is available to you starting right now.